Many people were anticipating a strong cycle. We've had that strong cycle. And the question is, what's next? And given that the stock is relatively still remains elevated in its valuation, and there isn't an obvious near-term catalyst, it's unclear whether the stock is a candidate to outperform in the near term.
Right. To the degree that the company can earn their way back into better graces, as you point out, people have hopes about a revolutionary phone or VR. I see some other reports today saying a car is really just too far out to put in the model. What would be next in terms of a driver for growth or earnings?
Well, I think, there are a few things that could happen. You never know when Apple might come out with a surprise or revolutionary product. The iPad was no one suspected it. It was truly a surprise offering. So you never know what Apple might come out with. I think, more structurally, if Apple were to show that its gross margins, which historically have been pressured, might stabilize and go up because of the mix shift to services, that could be positive for the stock. If the company was able to bring to market sort of integrated products and services and make the company more subscription-like, that might help. But for now, I think investors are sort of saying, great cycle, stocks are relatively expensive, and, the company's really benefited in its Mac and iPad business from COVID. And so, that business sort of a year from now may also be challenged to grow at the same rate. So there really aren't the catalysts right now for the stock. And I think that's a big driver for why you're seeing relative underperformance here.
Tony, I could push back on you and say the cycle for Apple putting its own chips in Macs has only begun. They're going to see not only margin benefit from that, but they're going to see a lot of positive headlines around battery life and other types of performance that others won't be able to match. So I guess my underlying question is, in an environment with higher rates that still probably aren't going to be super high, but higher rates, what kinds of stocks that you track are going to be more or less dangerous? Because Apple, being the fortress balance sheet that it is, it seems like it's going to be okay with its plans pretty much no matter what happens outside the walls.
John, I agree with that assessment that, Apple is a high quality fortress balance sheet type company. I think the question for all investors is, what do we pay for Apple relative to other companies? Microsoft is trading at a similar valuation. Google is actually trading at a lower price to forward earnings multiple. Facebook is trading at 21 times earnings. Apple's trading at 28 times earnings. And so I don't think it's really a question of doubt around, Apple as an attractive ongoing company. The question is, what's the right entry point? A year from now, Apple was trading dramatically lower than those other names, and there was a 5G cycle to look forward to. And, that has largely played out, and the stock's done really, really well. So what investors are always thinking about is, what's the opportunity cost of owning this stock relative to other things? And at this point, my belief is many investors are saying, great run. There are other stocks that haven't had as strong a run, and I mentioned some of them that are trading at or lower multiples than Apple, and arguably have similar fortress balance sheets and similar to better growth profiles.
Right. Speaking of those less pricey in terms of valuation names, I can't help but look at the legacy tech names, right? Like Oracle, Dell, Cisco, IBM. They really sat out last year's, FOMO rally. But this year, they're outperforming FANG. And over the last few weeks, they're really outperforming many of last year's newer tech darlings. Is it time for investors to take a look at those names? And are they really long-term bets?
Well, certainly that has been occurring. So we've had a spectacular run of growth where technology has outperformed for 8 straight years, and growth stocks in particular, which is a big subsegment of technology stocks, has massively outperformed. So last year we saw the biggest relative outperformance of growth stocks versus value stocks in the last 20 years. And so, again, much like what went up has to come down, there was enormous underperformance in value across the market, and particularly in technology. And so you have seen IT hardware stocks like Hewlett-Packard Inc. or Hewlett-Packard Enterprise or Dell do very well on a relative basis this year because the stocks look pretty, pretty attractively valued on a relative basis. Look, they are not, many of those stocks that I noted, they're not secular growers. And so they tend to be much more trading stocks. You buy them when they're inexpensive or when there might be a catalyst. And right now we're seeing a market rotation to those names. If you can buy a stock at 8, 9, 10 times earnings, the market is more comfortable doing that right now rather than buying a stock at 30, 40, 50 times earnings, in part because of the rate environment and the broader shift away from higher multiple stocks.
Yeah. Even as you say it, Tony, NASDAQ down almost 2%, on pace for the worst week in about a year. Tony, it's a great note. We always appreciate you coming on and talking more about it. Good to see you.
Thanks, Carl. Nice to see you.